on the show, we've decided to talk about bond yields. A very complicated topic, but it's something that can help you make money. How? That's what we're going to talk about. Additionally, gilt funds, what are they? Well, firstly, they've made a lot of money for investors in the last 1 year. The question is, should you still buy them? Next, for all the investors in the Axis Large Cap Equity Fund, you'll want to stay tuned in because the fund manager of that fund, Jinesh Gopani, is going to be joining us to share his strategy on our Meet Your Fund Manager segment. Remember, Axis Large Cap Equity is the largest ELSS fund so far. And finally, on our Spend with TMS segment, Pakistan has opened up its airspace for commercial airlines, which means fares especially to Europe and America have dropped. Know which destination flights prices have dropped on our Spend with TMS segment. And of course, as always, our phone lines will be open over the course of the next 1 hour. So keep your questions and queries on personal finance, on travel ready, and we will answer them. For now, the top headlines. Autonomy debate reignited. Sources suggest SEBI chief has written to the finance minister seeking a review of budget proposal that mandates transferring surplus funds to the government. Ajay Tyagi says the move undermines SEBI's financial autonomy. Markets fall with a thud in the last hour. The Nifty shuts shop below 11,600, while the Sensex gives up over 300 points. PSU banks bleed. Metals and auto as well struggle. No measures announced by the government to ring-fence overseas investors from the tax jolt. The government introduces amendments to the finance bill without making any changes in the proposal to hike taxes for FPIs. It's an ET Now exclusive. Flipkart founder Sachin Bansal looks to add the mutual fund business into his cart. Sources tell your channel that Bansal may be in advanced talks with the Goyals of Z Group to buy out SL Mutual Fund and transform it into a tech-backed platform. Some light at the end of the tunnel. Committee of Creditors for Jet Airways hopes to get 3 to 4 names participating in the auction for the troubled airlines. Sources tell ET Now the Aviation Ministry may hold back some slots for the bidder who wins Jet. Netflix plans to introduce cheaper subscription plan for India. The idea comes after a company added fewer subscribers than expected in the second quarter earnings. Reports suggest the plan could be priced at just 300 rupees. High drama in the Karnataka Assembly. Chief Minister H.D. Kumaraswamy moves the trust motion, launching a scathing attack on the BJP and blaming it for causing political instability. Congress JDS combined claims they have the numbers, even as rebels refuse to budge on resignations. India ups the ante against Pakistan a day after the ICJ ordered Pakistan to review death penalty for Kulbhushan Jadhav. S. Jaishankar calls up Pakistan to release and repatriate Jadhav. Foreign Affairs Ministry says detention of Jadhav is now illegal. Well, there you have it, a wrap of all the top stories that you should know. But like I said, today's day is going to be all about personal finance, and the topic that we want to talk about is bond yields. What are they? And did you know that when a bond yield moves, you too have the opportunity to make money? That's what we are going to be discussing over the course of the next 20 minutes. So if you have any questions on personal finance, on debt funds, on gilt funds, call in. The number will shortly appear on the top of your screens. And of course, in the meanwhile, we will be answering all the email questions we have received today on the show. And to do that, we have with us Mr. Hemant Rastagi, and he is going to be joining us to talk about all of this. Mr. Rastagi, thank you for joining us on the Money Show. It's a pleasure having you with us as always. Let's talk about bond yields. In fact, I'm just going to pull up how bond yields have moved, what it is at today and what it was approximately 2 years ago, and it's quite a marked difference because of the RBI stance, because of what's happening in terms of the global economy. And there you have it. In September 2018, in fact not even 2 years, just about a year ago, 8.13, and now it's fallen to 6.38. It's a great money-making opportunity. But I think for all our viewers out there who don't know exactly, I mean, prima facie, it looks like, hey, if it's fallen, however, I made money, right? So to start with, if you could just give our viewers a briefer on how yields and bonds prices move inversely.
As you rightly mentioned, what happens is that equity market, when the markets go up, investors become very happy saying that, okay, this is the time to make money. But it works the other way around as far as the bonds are concerned. That's because, there's an inverse relationship between the bond yields and the bond prices. So typically what happens is when the yields go down, as we just saw that they've almost, from 8.18, they've come to 6.38. What typically happens when the bond yields come down, the new bonds offer you less rate of interest, and the existing bonds which are already there, which are offering higher rate of interest, are more in demand. So what typically happens is that everyone wants to buy the bond which are offering higher rate of interest. So the bond prices move up. That's where the bond fund, the gilt funds actually benefit from that. So typically what happens is because they already are holding bonds in their portfolio, the NAV starts moving up. That's why we are seeing actually, if you see the gilt funds especially have given 16-17% return in the last 1 year. So it's mainly because of the inverse relationship which is there between bond yields and the bond prices.
So by that argument then, Mr. Rastagi, we should see even debt funds, which basically invest in all these bonds and corporate securities. By that argument, debt mutual funds as well. I'm sure they must be praying for this sort of an equation to come by then. So, but of course, there are all these overbearing factors as well in debt mutual funds. And that's, of course, speaking of the DHFL crisis, RLNFS crisis, which we as well on the Money Show have covered very widely. So in such a scenario, what should debt mutual fund holders do?
Well, that's a very interesting question that you're asking. See, what typically happens, like I said, the gilt funds have shown fantastic return over the last 1 year.
That's of course
the debt funds haven't shown because there are two things. While I've explained that there is an inverse relationship, the impact of the bond yield, the bond prices, will depend on what is the maturity duration of the security. So typically what happens when we talk about government securities, the maturity could be 10 years, 15, 20, 25 years. Whereas if you look at the bond fund, okay, depending on the kind of bond fund, even if you're in a duration fund, the average maturity is going to be 5, 6, 7 years.
Yeah.
So clearly, even if the impact is there, impact won't be exactly the same which you see in a gilt fund. And that's exactly the reason why you're seeing the gilt funds right at the top of the table.
Yeah. So the duration of the bonds that are held by the fund, that matters. Gilt funds, which by the way for our viewers are those funds that invest in government securities. So obviously they have zero credit risk, but they always have that interest rate risk, which we will come to shortly. These are what the gilt funds have done. And take a look, Mr. Rastagi, I mean 18%, 17%, these are the kind of returns, these gilt funds have given and from a 1 year time horizon. So that's the reason why perhaps these gilt funds have done well. But folks, like I said, Mr. Rastagi is here and it's your golden chance to get your questions and queries answered by him. 24990388, and in the meanwhile we will take up some email queries and we've received a lot of them. So let's kickstart our Ask the Money Show segment. Our very first question we have received is from Dipankar Nath. He asks, I wanted to know about the expense ratio on schemes. What does it mean and what should be the ideal ratio? Very often we see this in our fact sheets of these mutual funds, but we don't understand what that means. So what is an ideal ratio and how is it calculated? What all does it include?
Sure. I think it's very important for any investor who invests in the mutual fund to know what the expense ratio is. As he said, he wants to know about the expense ratio, which is also known as TER, total expense ratio, which is basically charged to the fund on an annual basis. The best thing about these expenses is that SEBI has prescribed how much can be charged, how much can be charged for each category of fund. Now, let me explain that there are two categories of funds here. One is the equity fund, the other one is the debt fund. Equity funds are all those funds which invest 65% more in equity. Rest all are considered as debt fund. So there is a limit for each category of fund. Second, SEBI has also prescribed what can be charged as expense. It's not that the AMC can decide to charge anything and everything in that.
Yeah.
Now, what are the major expenses that are charged in the TER? One is the investment management fee, which is charged by the AMC for managing your fund. There are custodial charges. There are investor communication. There is a brokerage which is paid. Okay, so these are the expenses which can be charged. Now, what typically happens in an equity fund, the maximum that a fund can charge you is 2.25%. And that happens only in the first slab of 0 to 500 crore. As the AUM of the fund increases, the expense ratio comes down. So the moment an equity fund reaches 50,000 crore and more, okay, the cap is 1.05. See, from 2.25, it comes to 1.05. Similarly, if you look at the debt fund, the maximum that they can charge is 2%. And when they reach 50,000 crore, they can charge 80 basis points. There will always be a difference of 25 basis points between an equity fund and a debt fund. So like I said, this is important for every investor to know how much is being charged. The second important thing is the NAV that you see is post charging of these expenses. So they are basically net of expenses. So when you look at your NAV, when you look at the return, they're post expenses. Everything has been taken care of. This is what comes in the hand of investors.
The investor, yeah. So it's a final picture, basically, the NAV. I just have one question, Mr. Rustagi. When you talk about active funds and passive funds, I'm assuming that active funds will obviously have a higher expense ratio. But by how much? I mean, is it substantial? Because, you know, very often investors wonder that what they are paying for these active funds, is the active fund actually able to generate that alpha, which obviously passive or index funds can't?
But that's an important issue. If you look at the passive fund, I think the cap is at 1%.
Okay.
So clearly the expenses are, so one of the benefit of investing in a passive fund is that because you're not using fund manager expertise, the fund manager is not really using his experience, his knowledge, his strategy.
Right.
He's just trying to mimic what is there in the index. So obviously the charges are much lower. So 1% is what you pay. But second important question that you raise about whether the enough alpha is being generated by the fund manager because I'm charging more. See what typically happens if you see the last 1 year, okay, because the market has been so narrow in terms of only 6 or 7 stocks have done well.
Yeah, the breadth
so
has been
clearly what has happened, only the large cap funds have done well, and even there, if you compare that with ETF, okay, ETFs are done better than the actively managed fund.
Right.
But then that scenario will change once the market becomes more broad based. Once you see the mid cap and the small cap stocks doing well, you will see the multi caps doing better, you'll see small cap and mid cap doing better. But obviously till that happens, there is always going to be a period where you'll see that the passively managed funds are giving you better return. But it does not mean because they have done well for the last 1 year that you change your portfolio entirely to passive fund. I believe in a market like India, you still have few years where you will see the actively fund managers will be able to generate higher return than the passive managed fund.
Okay, all right. Let's move on to our next question then on our Ask the Money Show segment. Kruti Desai has sent in a question. She says, I'm an NRI, I'm 28 years old and looking to invest in mutual funds for wealth creation, and also she wants to know, and for retirement, she wants to know, please suggest some good SIPs. She can invest 10,000 rupees on a monthly basis, can also increase it on a year-on-year basis. Her risk appetite is more or less moderate. So first time investor, 28 years, so she's still young and she's an NRI. So what would you recommend she start off with? Unfortunately, she hasn't given what her current salary or any other financials are, but she has said that she's looking for wealth creation and retirement. So she wants to invest for the long haul. What would you recommend?
Well, assuming that the fact that the intent is to invest for the long run, and the fact that intent is also to invest through SIP, which I think is the best way for someone who wants to accumulate money over a period of time. And second, because it brings in, brings in discipline in your investment process. Second is we've seen the volatility in the equity market. So how do you tackle the volatility is by sticking to making investment on a monthly basis. And third important thing which you mentioned very clearly is that she wants to increase the SIP amount by 1,000 rupees every year. Which again, I think in terms of strategy, she is perfectly all right. Because the intent is to invest for the long term, she should be starting with well-diversified equity funds. So I'm recommending 3 funds for her. One in the multi-cap category, especially the fund which has a higher exposure to large cap right now, which is Kotak Standard multi-cap. The second is Reliance Large Cap Fund, is one of the best performing large cap fund. And the third is Excess Mid Cap Fund. I believe that there has to be good exposure to all the 3 segments of the market. But since she is the first time investor, I'm asking her to stay away from the small cap funds right now. So maybe include one mid cap fund in that. And the allocation should be 4,000 in a multi cap and 3,000 each in a large cap and a mid cap. So I think that's how she should begin. And there is no need to have too many funds in the portfolio. It's not that when she's increasing by 1,000 every year, she should be adding one fund. I think these 3 funds for the next 4 or 5 years are good enough. It's only when the amount of investment increases substantially is where she can think of actually including a small cap fund in the portfolio.
Okay, all right. And funds, mutual funds itself are a diversified product. So there's no point of diversifying more by buying more and more mutual funds. You're just going to increase, I think, your costs.
Exactly. Each fund will have 40, 50 stocks. I mean, how many stocks do you want in the portfolio?
And there'll be an overlap as well, I assume, in many cases.
That's the reason I said large cap, multi cap, and a
mid cap. All right. Okay. So, Kruti, I hope we've helped you kickstart your SIP and investment journey, and we wish you good luck for that. Okay. Moving on, let's take up our next question, which will appear on your screens in just a bit. We have Mr. P. Bobby, who has sent in a question. He says, are balanced advantage funds better than equity funds, Mr. Rustagi?
Well, I think both are different categories.
Yeah.
As the name suggests, equity fund is a fund which invests 100% into equity.
Yeah.
Maybe they keep something in cash or some debt securities. The balanced advantage fund, on the other hand, is actually a hybrid fund which invests in a combination of equity, arbitrage, and debt. So clearly, it depends on what is the suitability of as per your requirement. It's not that equity fund is better or a balanced advantage fund is better. Both have their pros and cons of investing in them. So if your time horizon is longer, and if you can take the risk of some amount of volatility to get higher return, equity funds would be ideal for you. But if your time horizon is, let's say, 3 to 4 years, or if you are someone that who do not want a lot of volatility in your portfolio, then the balanced advantage fund would be best. The important thing to remember here is that balanced fund invests in a combination of equity and arbitrage, as I mentioned, in a manner that the total of these two is more than 65%. So they become eligible for taxation for equity funds. So in terms of taxation, both are same. But because there are arbitrage, equity and debt, the volatility is lesser, the potential of return also is lesser. So clearly, as I mentioned earlier, both are great categories of fund, but it clearly depends on what your time horizon is or what your risk profile is, and you can choose which is the best for you. So it's not that A is better than B or B is better than A. It all depends on your own requirements.
Okay, well that of course is Mr. Rastogi's view on which kind of fund is better. Okay, we have Mr. Sunil Verma who's joining us live on the phone line. Good evening, Sunil. Thank you for calling us. What's your question? Sunil, if you can hear me, what's your question?
Yes.
Yes, good evening, sir. What's your query for Mr. Rastagi?
Myself, Sunil Sharma. My query is, I am holding 1,000 shares of GAIL, Gas Authority of India Limited.
Okay, so, you know what, Mr. Verma, I'll have to pause you right there. Unfortunately, we don't take stock queries, but I will request you to connect with us on Buy Now, Sell Now every day at 11 a.m. You can just tweet to us on ET Now and we will answer your query. But yeah, this show is, of course, a holistic personal finance show. We talk about mutual funds. And you know what, I'm going to go ahead and take the next question, which we have received via email. It is from Raja Prem Kumar P. He says that he has been for the last few years investing in the following direct plan SIPs, 10% annual top up, which I think is a fair practice to do. And let's pull up the funds that he has invested in, which he has been investing in. First up, there's the ICICI Prudential Blue Chip, where he has put in approximately 4,000 rupees. We also have the Franklin smaller composite, where he has put 2,000, and the Motilal Oswal multi-cap, he's put in 3,000 over there. Okay, the portfolio should, I think, come up in a bit. But yeah, basically his aim is he's looking to accrue 40 lakh rupees in 18 years. And please suggest if there is any tweaking required. Okay, we have it a bit joggled up. But yeah, basically ICICI Prudential, there's a blue chip, there's a small cap, smaller comp, I think that's a small cap fund, and there's a multi-cap. 40 lakhs in 18 years, he's roughly putting in 9,000, sorry. So firstly, do you think the amount is enough? Secondly, do you think 40 lakhs in 18 years is perhaps a bit too conservative a target or too small a target?
I think there are 2-3 aspects clearly. If you look at the portfolio per se, there is one large cap, one multi-cap and one small cap fund, which I mentioned some time ago. This is how a portfolio should be built. The only difference is we had recommended a mid-cap fund. Here he has a smaller cap fund, which is fine because the time horizon is 18 years.
Right.
So I think in terms of combination of fund is perfectly all right. Investing in equity as an asset class is again great option because the time horizon is there. Now in terms of whether 40 lakh is going to be enough or not, clearly I don't think after 18 years 40 lakh is going to be enough. But good news for him is that if he continues to invest his 9,000 and increase by 10%, and I assume a return of let's say 12% on an annualized basis,
is fair enough,
he should be having a corpus of around 1 crore 11 lakhs.
Okay, so he'll exceed his target.
He will certainly exceed. The key is, I think there are going to be many testing times during the next 18 years.
Of course.
There are going to be time when the markets are not doing very well. There are temptation at times to stop the SIP or start questioning your decision whether you're doing the right thing or not. So I think my advice to him would be that he should stick to his time horizon, stick to his portfolio, continue the investment process irrespective of what happens in the market during that period.
Okay.
He should be able to accumulate 1.11 lakh crore.
So if you're disciplined, if you continue with this top up 10%, you won't get 40, but you will get more than 1 crores. So good job firstly on the fund selection, and stay disciplined and you will turn wealthy.